Hey, this is Mike Swanson, Wall Street Window. I got a couple things I want to talk to you about today. Um, First of all, this is a tweet that Michael Burry recently made about Tesla stock. He is the famous star, I guess you'd call it, of the movie The Big Short. He made over $1 billion, well over $1 billion, shorting subprime securities in 2008. He was running a hedge fund and made a killing, and that made him famous. And people follow what he says and talks about. And here is a tweet he made about Tesla. And he said, if I am tweeting this, you can bet I am not short it, but I should be. And he talks about links to an article about a Tesla Megapack factory that caught fire at a substation in California. I don't think the story is really important, but it's more what he's implying in his tweet. And that is he's not short Tesla, but he should be short Tesla. Does that mean me and you should be betting against Tesla stock? Well, here's Tesla today, stock trading around $279 a share. It's been in a trading range now for almost 2 months between 310 as resistance, 270 as support. When a stock is in a range like this, it tends to make a big move. You know, if it closes below support, it'll just start dumping back down at the June lows. Or if it breaks out by closing above 310, you can expect a rally. He says we should short. The real thing is we are in a bear market. You're seeing the stock market decline, and it's down again today. So if you, I don't have a position right now, one way or the other of Tesla, but if I was going to take one, I would be shorting it because of the general market conditions. And that takes me to the second tweet I want to talk with you about that he did. And that is this one. There is risk growing in many sectors, the unfettered narrative feeding itself until the absurdity explodes, revealing the folly to all and easily starting a revolution. Now, what is he talking about here? In some ways, I think this is a little bit hyperbolic. I don't think we're on the verge of a revolution. But what is the unfettered narrative? I would say that narrative is coming apart, and there are people that see it happening. And he was at the forefront of having the foresight to see what was going to happen in 2008. So, what is really happening now? What is the most important factor in the stock market? It's so easy to focus on stock market price action. You look at the market, you see it's up and down. That's what catches your attention. The television or the financial media online, on the radio, on YouTube, no matter where, will try to give an explanation of the market action. Why did it go up or down that given day? Because people want to know that. But simple explanations are not really what drives things. And what was the narrative? Well, since 2009, since the crash that Michael Burry made a fortune betting against subprime securities, their narrative has been that the Federal Reserve has your back. On market corrections, the Fed would lower interest rates or increase quantitative easing bond buying operations, and then the market would go up. And interest rates got so low, in fact, that we were even told that, okay, yeah, stocks can have high PE ratios, they may have strange valuations, and some people may say it's a bubble, but because interest rates are low and at zero, it makes sense to keep buying the stocks because there's nowhere else to get yield, and people have got to put their money somewhere. And that narrative only increased in 2020 when the stock market crashed that spring. The Fed lowered rates again, more QE, the market went up more as a result, even went up to new highs and then had a great 2021. And that narrative provided the justification to keep buying stocks, no matter how high they went up. And yes, it got a bit absurd. You saw that with so-called meme stocks, the GameStop, the AMC, and other stocks of similar nature. And they peaked out. But now the absurdity is not simply exploding overnight. It's more slowly dying. Their narrative is over. And as he writes in the first sentence, the risk is growing. That's why almost everything in the financial markets is now falling. The only thing that has gone up that's in the past couple of weeks is the US dollar index. Almost every currency in the world has been declining. Even gold and silver have been declining. Even oil now has been falling in the past couple of weeks. Stock market was already going down. Bond funds are already going down. But we're seeing what this is the process of the end really of what had been a monetary regime from 2009 that is ending now, where the Fed is no longer lowering rates to make markets go up or doing QE to make markets go up, because the cost now is high inflation, and frankly the policies do not work. You're seeing that in England, where the government there announced, we're lowering taxes and we're going to do a payment system for people to help them in this time of rising energy prices in Europe. And their bond market fell. The pound fell to cause the situation to actually get worse. Blowback on the policies. And now there's talk that they're going to have to raise interest rates in England because of what's happened in the currency market. So there are the easy solutions and easy money ways of doing things is over. And now what we're seeing is the process of that unwinding as we enter a new financial era. That's what this bear market represents. And it's not exploding like in one day. It's more of an unwinding process. Now, the thing about stocks like Tesla is over the past couple months, I have at time. Well, let me show you this first. It's kind of really will drive the point I'm trying to make home to you. These are Treasury bond yields. And let me ask you this. If on January the 1st, I could have told you, I can guarantee that you can make 4% this year in your retirement accounts and your investment accounts with no risk at all, would you have taken that? If you could jump back in time now to January the 1st, you probably would say, yes, sign me up for a 4% return with zero risk. I want that, because look what's happened. Everything has dropped. And now you can get that. You can get a guaranteed 4% return. How? By putting your money in a 1-year treasury bond. You can make 4.15% yield if you do that. And that's one of the reasons why the stock market is falling, because when rates were zero, they no longer are zero. And now people can take money out of stocks and into treasury bonds. They don't even have to put it into a risky bond fund, which can drop in value. They can put it in a treasury bond of actually 3-month duration and get 3.24%, or a 60-day treasury bond, and just keep rolling that money over every 60 days until the stock market declines are over with, and then put the money to work. Pretty easy strategy with zero risk. People are doing that, and that is competition for stocks. So that story you were told 10 years ago is that, oh, rates are zero, so everyone has to put money in stocks. It's no longer true. we're in a new monetary regime, or making the transition into one. Now, stockbrokers are doing funny things. So for months, from time to time, I would point out that on Fidelity, you could track the top buys and sells every single day in real time. And we were looking at this and watching that over the past couple months, even though the stock market had been going down, traders were continuing to double down on risky stocks, often buying meme stocks that were complete and total garbage. The Fidelity had a list of the top 30 bought and sold stocks, and these meme stocks would regularly appear on the risk. That was evidence to us that small traders were still taking extreme risks in the market. They were not being cautious. They were acting as if this was not a bear market, but this was still 2021. That was a sign for us to be cautious, to ignore people who are calling for giant rallies and new bull markets and saying this is only a correction, because typically at the end of a bear market, people get cautious. They weren't doing that on Fidelity. And what Fidelity has done is something very sneaky. They have gotten rid of that page with all the order flow. I think they figured out this is really embarrassing to show the entire world that our customers are buying risky stocks and losing their behind in this market. So, they replaced it with this page, and I can't show it to you anymore. All we can see now are the top 6 positions, and it's not very helpful. Tesla is number 1 in these ETFs, and it's just not meaningful. But Tesla remains the top bought stock today, period, on Fidelity. We know that. Really nothing new though. So I just wanted, if you notice why don't I talk about Fidelity anymore in that order flow page, because they basically taken away, covered it up. They don't want us to see anymore the recklessness that their customers engage in. I want to see when they stop doing that and do more selling than buying, as a sign that the bear market is over. But maybe we can load this up and we'll see that one day, but not now. So interesting time in the markets. When we look at the S&P 500 here today, we're basically right on the June low. I know that's going to cause a lot of people to try to buy, looking for a double bottom, and maybe the market can go up tomorrow. Maybe the market can go up a week. Maybe we can get a rally of back up to 3,800 or something for people to chase and get the opportunity to play a double bottom. But it may not even do that. It may just languish here. So it's not worth playing. I'm not playing it. I'm not looking to buy until I really think the bottom is in. Short term, trying to buy short term rallies that might only last a few hours, that's a tough way to make money. And I'm much more content to be cautious in this market environment. Look, if this is the first time you see me on YouTube, hit like, so I'll know you're out there, and hit the subscribe button and hit the bell next to it. And then YouTube will send you an alert as soon as my next video is up, and I'll be talking with you later.